buyer out there that's about to go through the home buying journey without some degree of debt. But I've learned through the years that debt is not always a bad thing, and sometimes is weighted differently based on the types of debt. Or can you shed some light into, can someone buy a home if they have student loan debts and stuff?
For sure, yeah. So we call them liabilities or trade lines in the lending industry. So what we do when we pull their credit, the only items that we're going to count as debt within their debt to income ratios, a majority of the time, will be what's showing on their credit report. So let's walk through student loans, for example. Okay, some student loans are going to still be in deferment when we pull their credit report. So it's showing 0 as a payment. However, we as lenders understand eventually that loan is going to have to start to be repaid back. So depending on the type of financing that we're looking at, some of our investors will require us to calculate 0.5% of the student loan balance as monthly debt and calculate that. Other investors will require us to count 1% of that debt as monthly liabilities for their debt to income ratio. So if they're tight on getting approved, that is going to help us determine which investor we're going to go with, right?
Okay.
Because 0.5% versus 1% can be significant.
Sure.
When you're talking about student loans. Then you have your automobile loans, okay, and other installment loans. So installment loans are things like automobiles, student loans, things that the monthly payment is going to be set each month, just like the mortgage payment. Whereas revolving is like your credit cards. So as your balances are paid down, your payment changes each month. So when it comes to installment loans, if they have less than 10 months left on that installment loan, in some instances, we can just exclude that debt altogether and not even count that in their debt to income ratios.
Oh, wow. Okay.
Yep. And then you have collections. So collections are things, a majority of the time we do see these as medical, okay? In the lending industry and in financing, we don't look down too much on the medical collections because the majority of the time you're fighting with your insurance company, right? And they're wanting you to pay something even though they're responsible for it, and it will go into collection. So when it comes to financing, we don't look too strongly on the medical collections. We don't require them to be paid off. However, they can affect their credit score, right? So try your best to avoid having those go to collection if you can. But if they do, we're not going to require them to pay them off. Other collections, however, again, comes down to the investor, which is why you want to speak with us, someone who knows all the different loan options. Some may require other collections to be paid off. Some may not. So there's a lot of different things that come into play when we're looking at their liabilities on their credit report.
So it sounds like sometimes debt is a need, like medical and school, and sometimes it's a want, like my Discover balance.
Right.
And so it can be kind of weighed differently based on, because I maybe needed a kidney, but I wanted a nice birthday present for my beautiful
Or that Kohl's, discount. That's one thing
Yeah.
we tell people around Christmas time. Don't be opening up all these credit cards and taking advantage of these deals because you're opening up a credit card, because that is going to affect the credit score. We also look at the inquiries that they have. When they're opening up all these credit cards over the holidays, those inquiries are hitting their credit, and that is affecting their credit score.
And that affects them for years.
Yeah. So not only are we looking at their debt to income with the liabilities that we have, but now we're looking at their score too, and that can affect that there as well.
So long story short, they should probably go to you long before looking at homes to make sure that all their finances are working out. And if there is an issue or concern, maybe that can be addressed before we get too heavy into the process.
Absolutely. Because when it comes to student loans, even if they're out of deferment and let's say they don't qualify, they can go to their student loan company and do like an income repayment plan. So we as a lender can help guide them as to ways that maybe refinance their automobile to get their payment down a little bit to help them qualify. So there are things that we can look and analyze and provide maybe possible solutions so that they still qualify with the debt they have.
So the sooner they talk to you, the better off it probably is.
1,000%. And you never know until you try. So don't avoid calling us, right? Just because you think you have so much debt and you don't qualify. Make that call. Let us be the ones to tell you. And if you're not ready now, we can get you on, the path to home ownership 6 months, 9 months, 12 months down the road.
That would give me a lot of peace of mind. Thank you so much, Maureen.
Sure.